Back, still tuned into First Trades and pretty hefty rally that's playing out. Look at the screen and that really telling the story at 10,768. Although we have not moved the needle much since yesterday, that move in the positive direction, that certainly continues. Bajaj Holdings, Bandhan Bank, SAIL, Infosys, Shriram Transport, Dabur as well as Havells are some of the key gainers in today's trading session. Well, let's take the conversation forward. Vinod Karki, Head of Strategy at ICICI Securities, joining in to share with us his outlook. And Vinod, let's talk about the momentum in the markets, because whether it be attributed to a liquidity-driven rally or the fact that, we're riding on what's going on across the globe, the momentum is certainly intact. Do you believe we're just staging ourselves for, some sort of a solid crack as the fundamentals play catch up, or do you think that there will be no stopping this solid rally?
Hi, good morning, and thanks for having me on the show. So the way the market is set up, two things are happening. One, the stimulus that we had is from central banks and governments globally. Although India did not have, from the fiscal side, we did not have a big stimulus, but the RBI did its bit. The stimulus is kind of one of, unprecedented in the sense in terms of the timing. It was quick and the sheer magnitude. Now, the way this was being played out was that there was this fear that the economies will take long time to open up, and the second wave will be very lethal, as we had seen in the case of the Spanish flu. That's the only real empirical evidence we have in the past of such pandemics. But what has happened is, if you see the high frequency data for June, China is on an expansion mode in terms of PMI. A lot of countries are, although still they are contracting, the reading is still below 50, but the contraction is reducing. A lot of data around global mobility and other things, even some of the banks, they have given their initial results. It does seem to suggest that things are not as bad as it was being made out to be early on. So this combination of a mother of all kind of stimulus and the high frequency indicators showing that things are probably not as bad as originally thought to be is allowing this market to be quite resilient. So the story would have been very different if the second wave was very lethal and these numbers, high frequency numbers, were not as supportive as they are right now. So even for India, if you see, we are looking at if you look at the PMI, it's still contracting, but still improved. You had improvement in, the toll collection, the highway, e-way bill collection, filing. GST also showing some improvement, although it's kind of backlog which is coming in. But all in all, some of the financials. So the big worry that the market had was on the financial pack, especially in the Nifty. If you see, the most vulnerable sector was financials. But the early indicators for Q1 from some of the banks seem to suggest that maybe when the GDP is contracting maybe by double digit in Q1, the growth is not as bad as originally thought. So this mix of two things, and plus the risk appetite is rising globally. So the combination of these factors doesn't seem to suggest that big crack is around the corner right now from the trend that we have been seeing right now.
Vinod, let's talk earnings then. And how have you read into the March quarter numbers that have come in? Because there has been a decline, of course, owing to the lockdown and the kind of constraints that a lot of these companies have had to face. Going forward, your notes suggest that the Nifty earnings could grow at a 16% CAGR over FY20 to 22. What is the thesis behind that? What's the rationale?
Yeah, so no, so it will not be 16%. So note is saying that around 13, 14%, and a lot of it is due to base effect. So if you see the headline, the GDP number itself, most analysts and economists, they are forecasting 4 to 5% real GDP decline in 21, which effectively, if you say that the inflation is going to be around 4%, is largely a flat to slightly 1% kind of decline for the nominal GDP. And the 22 number is largely 6 to 7%, and you add another 4% inflation, it comes to 10, 11%. So the nominal GDP will largely be around 4 to 5% over 21, 22, going by current estimates. Typically, what happens is corporates have operating and financial leverage, which accentuates these movements. So if the GDP falls by, let's say, in nominal terms, 1%, the fall in corporate profitability can be even higher. So in 21, we could see a dip in profitability after a long time, profit growth by maybe around 10%. But in 22, due to low base and improvement in the demand to some extent at the aggregate level and kicking in of these leverage effects, the profit jump can be high. So overall, we feel that it is possible that a 13, 14% compounding can happen over 21, 22, which has downside risks to it, given how COVID can, if the second wave is very lethal. But there's nothing to prove it right now, given the high frequency indicators which are suggesting that recovery is also reasonably okay. So we had yesterday the U.S. services data was quite robust. But then at the same time, cases are also rising in the U.S. So it's a mix of hope and despair, I would say. But no, the jury is still out. So one can't bet either ways big time. But all said and done, the incoming data seems to suggest that things are not as bad as originally thought. That at least is kind of confirmed right now. And the stimulus continues. So the Fed has, for the first time, even embarked on buying corporate bonds. They've been buying junk ETF bonds. So the risk appetite is high right now. So yeah.
Okay, Vinod, in terms of strategy then going forward, what would you suggest sectorally? How would you approach the current market?
This, in fact, when the market was even below 10,000, what we have been advocating in our research is it is one of the most unprecedented times. So there can be a clear scenario where things can go out of hand and the cases can rise and you could have a second lockdown. So in that case, what can still happen is that there could be flight to quality again. So you cannot, in your portfolio, completely wish away the expensive quality stocks. So you have to have a decent amount of those stocks over there, even if they are expensive. But on the other side, what we have been constantly saying is that high quality cyclical stocks, which are typically banks and some of the consumer discretionary stocks, if the scenario unravels in which actually we have a V-shaped recovery, then these stocks, and we are not advocating going down the quality curve in any space, but high quality, high beta, cyclical stocks need to be in the portfolio. And the third type of portfolio, given the market crash, we have an opportunity where stable businesses, let's say utilities, or telecom, where the cash flow yields or the dividend yield or the earnings yield are high. Because see, globally we are moving in an environment where yields are at rock bottom, and typically, a robust business with high yields should outperform in this environment. So these three types of stocks we have been recommending right through this COVID crisis.
Hi, morning. Aisha as well joining in. On the point that you were making in your first answer about financials, actually, irrespective of it being a watershed quarter, if I look at the updates coming in from HDFC Bank for their Q1, or for that matter, as recent as yesterday, from a Bajaj Finance or a Bandhan Bank, this is mighty impressive and clearly a show of resilience. There were a lot of concerns when the moratorium got announced and then it got extended to 6 months as to what's going to be the future of financials or not. And irrespective of how distinct an HDFC Bank is from a Bandhan Bank to a Bajaj Finance, you're seeing sort of all corners of the financials covered and strong commentary coming in there. What does it tell you about investment opportunities even right now within the larger financial group, not just the top 5, irrespective of the smart recovery which is played out from the March lows in the entire segment?
So 2-3 things. One, even without this data, the thought process was, if you see the note we have put out before this data started coming in, is that first of all, this fear of NPA, it is not similar to what was in the earlier cycle. If you see the NPA cycle of the earlier, that happened earlier, it was largely driven by the core sector, high capital intensive sectors, and it was lumpy. And there were evidence of willful default. But if you look at the current scenario, the fear of NPA is largely focused around the MSME segment and unsecured retail lending. If you see whatever the government has done, the maximum has been done towards the agri sector and the MSME segment in terms of providing refinance and liquidity, right? So I would say that some mitigation of that risk happened, right? And if you see the rural space, agriculture will be the only space which will grow in FY21, right? And the outlook is looking good with monsoon coming in. So from that perspective, someone who is a microfinance maybe in the rural segment, at least from the income perspective, I don't see a big loss over there for the rural space as such, because that's the only good spot. In terms of what you should say, the unsecured retail loans, one has to bear in mind that unless a person is completely bankrupt, I don't see willful default happening here. When you need to be in this digital environment where your credit score is all that matters when you make all these payments and use e-commerce and all. So obviously there will be people who have completely lost their income and they, because loss of income, they will default. But willful default, and then you have to remember that there is a moratorium, and going by the data, a lot of, if you look at CMI data and all, it seems two things are happening. One, that the job are coming back strongly in the unorganized segment, and second, there has been anecdotal evidence that a lot of the, there is a sign of reverse migration which is happening. So if you give if the moratorium of 2-3 months allows some of these, a lot of these people who are in the unorganized segment to kind of at least recoup some of their income, I see very little chance of willful default happening at the granular loans which are under stress right now. Obviously, there will be, I'm not saying there will be no increase in NPA. There will be when overall things go down. But you have to remember, it's not like the earlier cycle where lumpy NPAs from infrastructure, power, and metals, those kind of sectors, which are difficult to resolve, those kind of things, and they prolong. So unsecured retail loan NPA cycle will be written off quickly. You can't prolong that. So you have to bear that also in mind when looking at this whole thing.
Sense. Vinod, I wish we had more time to chat with you, but got to take a commercial break. So thank you so much for taking the time out and speaking with us today.
Yeah.
Okay, that's the word coming in from Vinod Karki from ICICI Securities. We're going to take a very quick break on that note, but come right back. We've got a very special interaction lined up on the other side.